What's up guys, Nick here, back with another video. Robinhood has finally announced their long-anticipated IPO is almost here. Expected to launch sometime at the end of July or August 2021, you can now buy shares of Robinhood on Robinhood. But there's been a ton of controversy around this company lately. And on June 30th, 2021, FINRA fined Robinhood $70 million for relaying false or misleading information to their customers. The very next day, July 1st, Robinhood filed its paperwork with the SEC to list its shares on the NASDAQ, officially announcing its plans to go public. So I took a look at Robinhood's business as an investment, and I was pretty surprised with what I found. I think a lot of the negative headlines around this company are completely overblown, and the $35 billion valuation is actually a great price to buy this company at. So I'm pretty sure everybody watching this video at this point knows a little bit about Robinhood. They basically revolutionized commission-free smartphone stock trading. Traditionally, stock brokerages have charged a fee to customers to place trades, and for a lot of small investors with maybe only a few $100s to invest, this was a big barrier to starting their own investment account, even if they were somehow able to get past the account minimums. The founders of Robinhood wanted to make a platform where ordinary people could buy and sell stock. They would use a simple, very easy to use interface, no account minimums, and no commission fees for placing a trade. It started to catch on fairly quickly, becoming one of the most popular stock brokerages chosen by brand new stock investors, even myself when I got started in 2016. Robinhood calls this their mission to democratize finance for all. According to Robinhood's own research, more than 50% of Robinhood's customers are first-time investors. They also found that more than 80% of these new customers are organic or referred, meaning they found the app through the Play Store or the App Store, or they were recommended by a current user. Side note, if you like free money and you don't already have a Robinhood account, I have a link in the description where you can sign up and we can both get a free stock. Even if you don't have any interest in Robinhood as a platform, it's still worth it to get the free stock that you can sell and transfer to a stock that you like, or just pull the money out of the account. I mean, really, who doesn't like free money? Anyways, according to Charles Schwab, US retail investors, or in other words, non-professional investors, have an estimated $50 trillion in total assets. This is a huge number. To put it in perspective, all of the gold in the world is worth $9.3 trillion. So retail investors have over a little 5 times the value of all of the world's gold. Retail investors are a huge market that Robinhood is continuing to expand into. Robinhood expects this to be a significant driver of its growth. But Robinhood doesn't make its money by charging a commission fee to its users. Instead, they do something called PFOF, or Payment for Order Flow. Robinhood says in their S1 filing, in the case of equities, the fees we receive are typically based on the size of the publicly quoted bid-ask spread. That is, that we receive a fixed percentage of the difference between the publicly quoted bid and ask at the time the trade is executed. When I initially read this, I didn't really understand what this meant, so let me make this easier to understand. Let's say you put in an order for 37 shares of Google stock at the market price. The most recent quote for the ticker Google is $2,660.30. So you send your order request to your brokerage, let's say Robinhood in this case. Robinhood then takes your order and sends it to a market maker who pays Robinhood for the order. The market maker will then buy all 37 shares and then quickly try to sell all of those shares for a very small amount more than they purchased, sometimes just the difference of a fraction of a penny. This exchange increases the speed orders are filled because now you don't have to wait for somebody else looking to buy 37 shares at the exact same price that you're looking to sell. But the payment for order flow practice, done by all commission-free brokerages, including Robinhood, is under scrutiny by the SEC. SEC Chairman Jerry Gensler explained his concern is brokers profit when investors trade. And for those brokers who have arrangements with market makers, higher trading volume generates more payment for order flow. What makes the current zero-commission brokerage environment different is that investors do not see the cost as they're executing trades, so they may perceive them as free. Now, for most users who are looking to buy and hold stock long-term, this really isn't that impactful. That means if you open your Robinhood account to buy and hold a couple shares of Apple for the next few months or years, you're still likely paying next to nothing for this. But still, most Robinhood users are completely unaware that zero commission trades doesn't mean that it's completely free. As a long-term Robinhood user, I've experienced what some people call the Robinhood tax. Sometimes when you put an order through, you have to raise your price order slightly above what Robinhood lists as the quote if you ever want to get it filled. So you end up paying a little more than the quoted price just to make sure your order immediately gets filled. Now, I'm not accusing Robinhood of doing this, but let me explain why payment for order flow can be bad. Let's say I need to fill an order to sell 100 shares of the ticker BAD stock for $5, and I need to do it right now because I'm expecting the stock price to fall very soon. I put in the order at the market price and it doesn't fill right away, so I immediately cancel the order and lower the amount I'm willing to sell by 20 cents. Well, a brokerage could potentially sell the order to a market maker who might not have our interests in mind when they fill the order. The market maker, seeing the stock is falling, could see that initial $5 order come through and not want to fill it because it doesn't want to get stuck with that stock and take a loss on it. So you see your order not going through, so you cancel the order, lower the price by a good amount, and send it back. The market maker likes buying this price much better, so they fill your order and sell the shares they bought from you to somebody else for $4.90. Because market makers are buying and selling your stock and in charge of filling your orders, there's a direct conflict of interest if they decide to choose which stocks they want to buy and sell. This practice nearly outlawed payment for order flow in the 90s. The SEC ended up implementing rules requiring in the US accepting payment for order flow is only allowed if no other exchange is quoting a better price on the national market system. Also, the broker must disclose to the client it accepts payment for order flow, and transactions must be executed at the best execution, which could mean best price available or the speediest execution available. Both Canada and the UK have banned the practice. In the US, the major market maker is Citadel Securities. They handle about 46% of market orders from retail investors, and Virtue Financial handles about 25% of retail market orders. So the potential is there for them to be able to influence the prices stocks trade. However, I do think under the payment for order flow business, it does seem much cheaper to buy and sell stock through this than the old commission-based fee model. TD Ameritrade, for example, used to charge between $5 and $7 per trade in the past. Alright, so now that we know what payment for order flow is, let's take a look at Robinhood's business and see how it's actually performing. Looking at their revenue and net income growth, we can see Robinhood has continued to grow at a pretty rapid pace. In 2017, they took in $49 million in revenue, and just over the last 12 months, they brought in just over $1 billion. However, they have also taken huge losses. Over the last year, they lost $1.4 billion, which is more than the total revenue they took in during this period. Also, just a little side note, looking at the Robinhood S1 filing, they included a chart that shows some of their key data. Well, if you don't read the numbers, the net loss segment doesn't look too bad, but the size of the bars are distorted, making net income look better than it was. Looking at the size of the bars for the $6 million loss compared with the $7 million gain they made last year, the $7 million 2020 bar is basically the same size as the $57 million loss bar. But anyways, looking at active users on the platform, we see really good growth. In 2020, we saw a huge amount of interest in people looking to invest as the stock market was rebounding. Then we see a second huge spike in the first quarter of 2021, which is probably from what I'm going to call GameStop madness. When we look at their expenses, we see exactly why it's important to take a look at operational income as well as net income. The operation itself is way better than we would think after looking at revenue and net income. They actually ended with a slight operational profit. The reason they took a $1.4 billion net loss is due to a change in the fair value of convertible notes and warrant liabilities. This has to do with the emergency fundraising they had to do in February during the GameStop craze, and it should only be a one-time expense. Now, Robinhood considers themselves a one-segment business, but they break their revenue sources down into 3 segments: transaction revenue, net interest revenue, and other revenue. We can see transaction revenue, or payment for order flow, is by far the majority of their revenue. Net interest revenue is generated from their lending program and interest from margin and cash deposits. They also take in subscription revenue from Robinhood Gold. Alright, so now that we've taken a look at Robinhood's business, let's take a look at the IPO price, and I'll show you why I think it's worth buying. But before I do that, if you could just scroll down really quick and hit the thumbs up button, it really helps out the channel and I would really appreciate it. So Robinhood expects to go public between $38 to $42 per share, making the IPO valuation worth roughly $35 billion. We're going to use a price to sales ratio since they don't have a long history of profitability yet for us to use. But for this, we need to estimate 2 things: margin and growth. Also, if you want to try this with your own numbers, check out the Google Sheet link below in the description. You can actually use it as a fair PE or fair price to sales ratio calculator for any stock that you want. All you have to do is type in the numbers that you expect for the company. So for Robinhood, we'll start with margin, but it's hard to find any direct comparisons to figure out what exactly brokerages should be gaining as profit margin. But Charles Schwab's overall business makes 26% margin. And while this isn't perfect, I'll use this as a top end estimate, and I'll use a more conservative 15% margin for the bottom end. I think Robinhood's business should be able to maintain margins above 15%. I'm only using a number lower than I expect just to price in some of the potential risks the SEC puts some some kind of regulation on payment for order flow, putting pressure on their eventual margins. However, keep in mind that if the SEC were to ban this practice entirely, this entire valuation is completely worthless because of the major impact on Robinhood's business plan. I think for growth, Robinhood should be priced with an expectation of 30%. This past year has seen a ton of interest with new investors, and I see Robinhood continuing as the go-to brokerage for new investors because of its ease of use and name recognition. Using my fair price to sales calculator, 30% growth and 15% margin gives us a low-end price to sales ratio of 25. When we increase the margins to 26%, this gives us a top-end number of 32. But right now there aren't any analyst growth projections for Robinhood, so for now we'll have to use my own estimates. When the investment banks do put out their own projections, you should choose to use those over mine. So here's my forecasted growth for Robinhood going out to 2023. I expect them to end this year with a big loss because of the $1.4 billion hit they took from the emergency funding. I also expect revenue to continue to grow, but I don't expect the 100% plus annual revenue growth that we've seen. $2.5 billion in revenue for 2023 seems like a very conservative estimate for them going forward. To be perfectly honest, I would not be entirely surprised if they end up exceeding all of these revenue projections in the future. I did make all of them fairly conservative because I prefer to underguess than overguess. I also expect that Robinhood should be profitable by 2022, if not by 2023, since they are currently having an operational profit. The loss from the emergency funding is making things look worse than they really are, and because Robinhood is still working to increase operational capacity to keep up with rapid growth, I'm estimating 10% profit margins for 2022 and 15% margins for 2023. I expect these margins will continue to improve as they move forward towards 20 to 25%. Looking at this valuation charted out, we have the orange line representing the middle of the IPO range, between 38 to 42. A $40 share price represents a $35 billion valuation. We can see that the IPO is fairly valued, and if you were able to get in at the $40 share price, you could expect between $91 to $71 per share by 2023, or a $78 to $128 return. Now, there have been a whole lot of sensationalist headlines about the Robinhood IPO saying that it's ultra risky and that they reported huge losses. But these headlines miss the fact that they would have probably ended up with a slight profit, if not breaking even, if they didn't have to take on the emergency funding that they did in February. Because the SEC rightfully doesn't seem to like the lack of transparency under payment for order flow, I do expect them to impose some rules against the practice. However, I don't expect them to ban the practice outright because there are way too many commission-free brokerages right now, and I think in general commissions do put up a big barrier to entry for a lot of young investors looking to get started in the stock market. I expect that there will be some restriction to the market makers' ability to take advantage of the bid-ask spreads, and in return this will cut down some of the fees that are paid to brokerages like Robinhood for the payment for order flows. I think the Robinhood IPO is an opportunity to get into a business that has rapidly changed how stock brokerages work. They certainly have their flaws and their shortcomings, but don't let that keep you from missing out on a very impressive business that's in great position to keep growing going forward. So that's the video. If you liked it, make sure you subscribe and hit the bell notification so you know whenever I upload a new video. And as always, thanks for watching.